Welcome to the Deep Dive, where we cut through the noise to bring you the crucial insights you need. Today, we're diving into the recent StoneX Group Inc., that's SNEX, their Q3 fiscal 2025 earnings call. And this wasn't just, business as usual. It was a quarter packed with big strategic moves for StoneX, but also, well, some unexpected bumps that definitely made waves in the market.
That's right. And our mission today, really, is to synthesize those financial results, dissect what management's saying about their strategy, and put it all into context for you. We want you to understand not just what happened, but fundamentally why it matters for where StoneX might be heading. It's a fascinating look at a company juggling ambitious growth and some short-term headwinds.
Okay, so let's start with the headlines, the numbers that first hit the wire. StoneX reported diluted earnings per share of $1.22 for Q3. And right away, that was a miss compared to what analysts were expecting.
Yeah, a slight miss there. And on the revenue side, you saw operating revenues show a pretty solid 12% year-over-year increase, hit $1.024 billion.
Yeah.
But, and this is key, their net operating revenues, NRR, which is a cleaner look at their core business that grew more modestly, only 4% year-over-year, reaching $488.3 million.
So the gross number looks strong, but the net figure, a bit softer, suggests maybe some underlying pressures there.
Exactly. It hints that maybe costs or other factors are weighing things down a little bit relative to that top-line growth.
And the market's reaction seemed quite telling, didn't it? It felt like there was a gap between the numbers and the long-term story management was pushing.
Oh, absolutely. The reaction was quite notable. After the release, the stock took a significant hit, opened down substantially, closed the day with a considerable decline. And that was an increased trading volume, too. So this initial caution from the market really highlights this divergence, right, between the reported numbers and management's confident strategic narrative. It suggests investors were very focused on those immediate results, maybe overlooking the bigger picture StoneX is trying to paint. Creates a really interesting tension.
Yeah, that tension is exactly what we want to get into. So the biggest question after that report was probably about that EPS miss. What was really driving that? Was it operational?
Good question. And importantly, the main reason for that diluted EPS miss wasn't really an operational issue in their core day-to-day businesses. Instead, it came down to a pre-tax charge, about $8.9 million. And it was related to those recent acquisitions they made.
Okay, acquisition costs. What specifically?
Specifically, $6.5 million in bridge loan financing fees and another $2.4 million in professional fees. Just the costs associated with getting those deals done. Together, those costs shaved about $0.12 off the diluted EPS.
Right. So it's kind of the cost of doing business when you're growing through acquisition.
Exactly. It's that classic growth pain. It highlights that dilemma for investors, doesn't it? Do you penalize a short-term hit that's meant to fuel long-term strategic advantage? Or do you try to look past the immediate numbers? StoneX is clearly betting investors will see the bigger picture.
That makes sense. It's a cost of growth, like you said, not necessarily a crack in the foundation. Now, StoneX often talks about the diversity of their business model. How did the different segments actually perform this quarter? Did that diversity help?
It absolutely did. That diversity was definitely on display, and it helped them navigate some pretty varied market conditions. Take the institutional segment, for example. That really shone. Achieved record net operating revenues up a solid 27%, and segment income surged 41%.
Wow. Okay, what drove that?
Largely driven by a big 30% jump in securities operating revenues, particularly in equity markets. Seems they benefited from increased volatility and strong client engagement there. Shows the power of having multiple growth engines.
Right. And it wasn't just the institutional side firing on all cylinders, was it? The self-directed retail segment also looked pretty strong.
You're absolutely right. The self-directed retail segment also showed really robust performance. Net operating revenues up 18%, and segment income jumped an impressive 49%.
49%. What was behind that surge?
Primarily, it was a huge increase, 34%, in the average daily volume of CFD contracts.
CFDs, contracts for difference, right?
Exactly. Allows traders to speculate on price moves without owning the asset, often using leverage. And StoneX's platform clearly captured a lot more client activity there. It shows real operating leverage in that part of the business. Higher volumes translate directly into that outsized income growth.
Okay, so institutional strong, retail strong. But the story wasn't uniformly positive across the board.
Yeah.
Where did we see some challenges?
Yeah, here's where you see the flip side of that diversity coin. The commercial segment, that saw a notable decline. Net operating revenues were down 24%, and segment income dropped 36%.
Ouch. What happened there?
Management pointed to a couple of things. First, A big 44% decline in physical contracts. They link that to tariff-related uncertainties, basically making clients hesitant. And second, lower commodity volatility hit their OTC derivatives business, especially in agriculture. That led to lower rate capture for them.
OTC, over-the-counter derivatives, so calmer markets hurt them there.
Precisely. These are privately negotiated contracts, and their value is often tied to volatility. So a quieter market directly impacted that segment's profitability. It was definitely a tough environment for commercial, reflecting some broader macro trends in ag.
And the payment segment, how did that do? Often a steadier piece?
It was steady, saw a modest 3% increase in net operating revenues, but segment income was basically flat. So not really a growth driver this quarter, but its stability probably provides a consistent base and, helps cement those client relationships across their whole ecosystem. Supports the bigger picture.
Makes sense. Now, another area that always gets scrutiny, especially with brokers, is float income, the interest they earn on client balances. How did that look for StoneX?
Right. So interest and fee income earned on those client balances actually decreased 11% year over year.
Decreased, even with acquisitions.
Yeah, and the main reason was simply lower short-term interest rates compared to last year. What's really interesting, though, is this happened even though their client balances grew by a healthy 10%.
So they had more client money, but earned less on it because rates were lower.
Exactly. And management put some numbers around the sensitivity. They said a 100 basis point shift in short-term rates up or down could impact their annualized net income by roughly $27 million.
Wow.
Or about $7.54 per share. So it really raises that question for investors.
Yeah.
How do they navigate if rates stay low? Or conversely, what's the potential boost if rates start ticking up again? It's a significant lever.
That sensitivity is definitely something to keep in mind. Okay, let's shift gears to the really big strategic moves that closed right near the end of the quarter, the acquisitions. StoneX made 2 significant deals. Can you walk us through those?
Absolutely. These are potentially transformative. First, they successfully closed the RJO acquisition on July 31st. Management described this as truly transformational. It positions StoneX as the largest non-bank futures commission merchant Gresham in the U.S.
The largest non-bank FCM. That's a big claim.
It is, and it's not just about size. It brings in nearly $6 billion in client float, which ties back to that interest income point we just discussed. And it's expected to be materially accretive to earnings and EPS pretty quickly. Critically, it hugely expands their derivatives scale, especially in areas like introducing brokers and institutional interest rate hedging.
And importantly, minimal customer overlap, right?
Very little overlap, which is key. It's a great example of smart consolidation, expanding their footprint without just eating into their existing business.
Okay, that's RJO. And the other one was the Benchmark company. How does that fit in?
Yes. The Benchmark company deal closed on August 5th. This one broadens StoneX's capital markets reach. It adds investment banking and equity research capabilities. Benchmark covers over 400 companies and connects StoneX with over 800 institutional accounts. So this is also expected to be accretive, fitting nicely into their institutional segment by letting them offer more to a wider range of clients.
And financing these deals, especially the big RJO one, how did they manage that?
The RJO deal specifically was financed with $625 million in senior secured notes. They carry a 6.875% coupon and are due in 2032. Management made a point of saying these notes were very well received by the market and actually priced tighter than their previous refinancing efforts. That suggests pretty strong market confidence in the deal and their ability to fund it.
Okay, so the deals are done. What about synergies? Particularly from RJO, what are the expectations and what's the timeline? This is where that long-term story really comes into play.
Right. Management is quite bullish here. They anticipate that the revenue synergies from RJO will eventually be multiples of the cost synergies.
Multiples.
Primarily through cross-selling. Taking StoneX's broader toolkit, things like their OTC products, structured products, physical commodities, logistics, and offering them to RJO's existing client base. Plus, combining their interest rate hedging capabilities. As for the timeline, they gave a phased approach. They expect the international parts of RJO to be integrated within, say, 3 to 6 months. That should account for maybe 40–45% of the total synergies.
Okay, relatively quick wins there.
But the larger U.S. integration, that's more complex and will likely take longer. Probably 9 to 12 months. Seems like a pragmatic plan. Get the easier bits done first.
Makes sense. Now, beyond the headline numbers and those big acquisitions, another really core piece of StoneX's infrastructure is their custody and clearing business. How did that foundational part perform, and why is it so critical?
Yeah, they highlighted this as absolutely foundational. It's the engine that enables their clients' trading, financing, and investment strategies across the board. It serves institutional clients globally, offering self-cleared equities, options, fixed income, futures, commodities, the whole range. And client assets in this segment topped $60 billion this quarter.
60 billion. That's substantial.
It is. And what's really interesting and important for institutional trust is their layered protection framework for those assets. They've got FDIC-insured programs for cash, SIPC coverage, plus excess insurance from Lloyd's of London, strict segregation of client assets. They use trusted global depositories. It's a robust setup designed to give clients peace of mind.
And are they expanding this segment, particularly into, well, newer areas like digital assets? That seems like a potentially big move.
It is a calculated and, I think, quite forward-looking move. They are actively pushing into digital asset custody. They've already received what's called VASP approval, Virtual Asset Service Provider, from the Central Bank of Ireland. That's a crucial regulatory step.
Okay, so they have the regulatory green light in Ireland. What's next?
They plan to launch lending and collateral management tools specifically for digital assets in Q4 fiscal 25, so pretty soon. And they expect to be regulated under ESMA, the European regulator, as a crypto asset service provider, or CASP, by Q1 fiscal 26.
So they're building a regulated institutional offering for crypto.
Exactly. This isn't just, tacking on a new service. It looks like a strategic move to position themselves in that institutional digital asset space, which is still evolving but highly regulated. It could potentially unlock whole new revenue streams and client types that more traditional brokers might be wary of.
Interesting. And what are their other priorities for custody and clearing?
Beyond digital assets, they mentioned building a multi-currency margin engine, scaling that digital custody piece, and piloting embedded clearing APIs, basically making it easier for others to plug into their infrastructure. They also want to diversify their client base further, maybe by expanding correspondent clearing and trying to capture business flowing away from some bank-affiliated FCMs, especially if banks continue to de-emphasize that area.
Right. Speaking of expansion, what about their retail segment? You mentioned the strong FXCFD growth. Are they sticking just to FX, or is there a bigger plan?
Oh, definitely a bigger plan. They're systematically transforming that self-directed retail segment. Moving beyond just FX, the goal seems to be a multi-asset class platform, maybe something more akin to an interactive brokers model.
That's ambitious.
It is. It involves a significant infrastructure rebuild, which they expect to complete by fiscal Q2 2026. The idea is that this will let them onboard retail clients into securities trading and then roll out derivatives products like futures throughout fiscal 2026. It's a long-term play, but could significantly broaden their retail appeal and revenue.
Okay. And one last point on industry trends, particularly around FCMs. Have they seen any signs of the big banks getting back into that business more seriously, or is the consolidation trend continuing?
According to management, they haven't really seen major banks rededicating themselves to the FCM business, even with some regulatory shifts that might have been expected to encourage it. So that suggests the opportunity for StoneX to keep consolidating in that market is still there. As larger players maybe continue to pull back or de-emphasize it, it acts as a sort of tailwind for strategic moves like that RJO acquisition.
Got it. And did they offer any specific financial guidance for the next quarter or the year?
No specific quantitative guidance was issued on this call, but they did say to expect a more detailed synergy timetable for the acquisitions and future updates. So more clarity to come on that front.
Okay, so let's try and synthesize all this for you, the listener, looking at StoneX now. You've got this immediate negative market reaction, right? Driven by the EPS miss, the softness in the commercial segment. But that clearly overshadowed management's pretty upbeat tone about the long-term picture diversification, synergy potential from these big deals. It creates this really interesting dynamic.
It really does. You have a company strategically positioning itself for what looks like significant long-term growth, but it's dealing with these short-term headwinds and, importantly, the costs of integration right now. It's that classic short-term pain for potential long-term gain scenario.
Right. So for anyone tracking StoneX, what are the key catalysts or things to watch out for in the coming quarters? What can move the needle here?
Yeah, there are several things to keep an eye on that could either, validate or maybe challenge this long-term growth thesis.
Okay, first up, I imagine, is updates on those synergies and the integration progress for RJO and Benchmark. That seems crucial.
Absolutely critical. Seeing progress there, getting confirmation those synergies are starting to materialize, that will be key to validating the value of these big strategic bets.
Second,
potential capital returns. They did recently report a new share buyback authorization. Any actual buybacks or other signals about returning capital to shareholders would show confidence in their future cash flow, even with the integration costs.
Third, the next big checkpoint is probably the year-end results call, right? Usually early December.
Exactly. That will give us the next major update on progress, outlook, and crucially, how these recent acquisitions are starting to actually impact the bottom line. A much clearer picture should emerge then.
And finally, those macro factors we discussed.
Right, critically important. Any turn in interest rates, especially an unexpected move higher, could directly boost that float income we talked about. That $1.54 per share sensitivity is significant. And similarly, any pickup in commodity volatility could reignite demand in that commercial hedging segment that was weak this quarter. These external factors could really shift the narrative.
Definitely key variables. Okay, now for the part where we put on our slightly more speculative hats. This is absolutely not financial advice, just a thought experiment based on everything we've discussed. Given StoneX's story, the acquisitions, the digital push, the market caution, how might a more, let's say, aggressive market participant view the situation?
Precisely. Let's explore an outrageous but maybe plausible trade idea. Again, purely hypothetical. Given that aggressive push into regulated digital asset custody, combined with the market's current sort of cautious stance and the potential for an unexpected rate hike, here's a setup to consider.
Okay, lay it out for us.
The setup. Long SNEX calls, specifically out-of-the-money calls, maybe expiring in fiscal Q4 2025 or fiscal Q1 2026.
Out-of-the-money calls. So betting on a significant move higher. What's the thesis?
It's kind of a two-pronged thesis, offering potentially double-barreled upside. First, the digital asset narrative re-rating. If StoneX successfully rolls out that regulated crypto custody, the lending, the collateral management in Q4 as planned, and then gets that KSP regulation in Q1 26, the market could start to re-rate SNX, see it not just as a traditional broker, but as a more diversified digital asset player. That could potentially unlock a whole new investor base driving the stock higher.
Okay, that's prong one, the crypto re-rating. What's prong two?
Prong two is the stealth rate hike benefit. We know lower rates are hurting float income right now. But if short-term rates were to tick up unexpectedly, remember that sensitivity. About $0.0754 per share annualized for every 100 basis points. Those out-of-the-money calls offer leveraged exposure to that potential surprise. They could magnify any positive stock move driven by a rate hike that the market isn't fully pricing in yet.
So you get potential upside from the digital assets story and leveraged upside from an unexpected rate hike.
That's the idea. Now, look, this is highly speculative. There's huge macro uncertainty. There are integration risks and costs. But the potential upside from that confluence, the digital re-rating plus a rate hike, could be significant. Potentially outsized returns for a relatively contained capital outlay using calls.
Got it. A high-risk, high-potential reward thought experiment. Definitely not advice.
Absolutely not advice. Just food for thought.
Okay, so wrapping up our deep dive today, we've covered a really dynamic quarter for StoneX. You've got these major strategic acquisitions clearly setting the stage for long-term growth. But at the same time, short-term earnings felt the pressure from integration costs and those macro headwinds, especially in the commercial segment.
It's that interplay, isn't it? Their diversified model, their expanding custody and clearing capabilities, especially that digital asset push and the ambitious transformation of their retail offering, it all positions them for future growth, even if the market's reacting cautiously right now.
Yeah. So maybe a final provocative thought for you to consider. What's the long-term impact of a company that's actively consolidating a fragmented industry like FCM's while simultaneously building out these cutting-edge regulated digital asset capabilities?
Yeah. How might that strategic chess match play out over the next few quarters? And what could it mean for their competitive moat as this increasingly diversified financial services player? Something to ponder.
Definitely. As always, remember this deep dive is purely for informational purposes. It is not financial advice. We really encourage you to continue exploring these topics and form your own informed perspectives. Thank you for joining us on the deep dive.